Welcome to Cyber Explorer, your trusted source for breaking down the complex topics shaping our world. Today, we're diving into a question on everyone's mind. Is cryptocurrency the future of money? Or is it the biggest financial illusion of the 21st century? Supporters say it will replace banks, transform finance, and make early investors incredibly wealthy. Critics, on the other hand, call it a digital Ponzi scheme, built on nothing but hype and speculation. If you've ever wondered why opinions on crypto are so extreme, you're not alone. Some people have made life-changing fortunes, while others have lost everything. So today, we're tackling the big question: is cryptocurrency a legitimate financial innovation, or is it a sophisticated scam? To find the truth, we need to explore how it all works, why critics are so suspicious, why supporters believe in it so strongly, and what the evidence really tells us. Let's break it down. The story of cryptocurrency starts back in 2008, right in the middle of the global financial crisis. Banks were collapsing, governments were issuing massive bailouts, and public trust in financial institutions was at an all-time low. Then, something unusual appeared online. A white paper written by someone using the name Satoshi Nakamoto. This paper introduced a new idea called Bitcoin. Bitcoin was designed to solve a problem that had stumped experts for decades: how to create digital money that doesn't need a bank to verify transactions. Normally, when you send money electronically, a bank confirms that the money is real and that you're authorized to send it. Bitcoin proposed something radically different: a system where transactions could be verified by a decentralized network of computers, not a central authority. This revolutionary technology became known as the blockchain, and it forever changed the conversation about money. So how does this actually work? At its core, cryptocurrency is just digital money recorded on a blockchain. Think of a blockchain as a public ledger, a giant digital accounting book. Every single transaction ever made is recorded on it, and is visible to anyone. But instead of being stored on a single bank's server, this ledger is copied and distributed across thousands of computers all over the world. These computers use complex cryptography to verify transactions. Once a transaction is confirmed, it gets added to a block, and that block is then added to the chain of previous blocks, hence the name blockchain. Because the ledger is spread out, no single person or company controls it. Supporters argue this creates a system that is transparent, decentralized, and resistant to censorship. But critics see it differently. They argue that while the technology might be interesting, the way cryptocurrencies gain value is deeply questionable. Before we can judge crypto, we need to understand what a Ponzi scheme actually is. A Ponzi scheme is a type of investment fraud where returns paid to early investors come directly from money contributed by newer investors. There's usually no real business or product generating profit. The whole system just survives by constantly attracting new money. Once new investors stop joining, the scheme collapses. The name comes from Charles Ponzi, who ran a famous scam in the 1920s. And more recently, Bernie Madoff operated one of the largest Ponzi schemes in history. In both cases, the structure was the same. Early investors were paid with money from new investors. So the uncomfortable question critics are asking is, does cryptocurrency follow a similar pattern? There are several reasons why critics believe cryptocurrency resembles a Ponzi structure. First, its value is often driven by new buyers. Unlike stocks, which represent ownership in a company that makes products or offers services, most cryptocurrencies don't generate any revenue or cash flow on their own. Their price goes up mainly when new buyers enter the market, which critics say sounds a lot like a Ponzi scheme. Second, there's the extreme speculation. Crypto markets are famous for their wild price swings. Bitcoin, for example, has seen multiple cycles where its price skyrocketed and then crashed dramatically. During these booms, hype spreads like wildfire on social media. Influencers promote coins, investors rush in, and prices climb higher and higher. Critics say this creates speculative bubbles driven by momentum rather than any real, fundamental value. And third, we've seen the collapse of major crypto projects. Projects that once promised revolutionary technology suddenly imploded, with some disappearing entirely and others turning out to be outright scams. These high-profile failures fuel the perception that the crypto market is full of schemes designed to attract investor money without delivering anything real in return. Despite all this criticism, millions of people strongly believe that cryptocurrency is a legitimate financial innovation. So what are their main arguments? First and foremost is decentralization. Our traditional financial systems rely on central institutions like banks to process transactions and governments to control currencies. Cryptocurrencies remove these middlemen. Instead, transactions are verified by a global network of computers. Supporters say this creates true financial freedom and independence from the traditional banking system. Another key argument is limited supply. Bitcoin, for example, has a hard cap of 21 million coins. No government or central bank can just decide to print more. Supporters argue this scarcity makes it like digital gold. Unlike traditional currencies that can be devalued through inflation, Bitcoin's limited supply is a key reason many investors believe it has long-term value. Finally, there's global accessibility. Cryptocurrency allows people to send money anywhere in the world without needing a bank. In regions with limited financial services or unstable currencies, crypto can provide access to digital payments and offer an alternative way to store value. One reason this debate is so intense is the massive influence of hype in social media. Posts can go viral, influencers can pump up a coin, and online communities can form powerful movements around specific projects. This can create incredible momentum, but it also creates huge risks. Hype can push prices far beyond any realistic valuation, and when that enthusiasm fades, prices can fall just as quickly. This pattern has repeated itself many times in crypto's history, which is why some critics say the market behaves more like speculative mania than a place for long-term investment. It's also important to understand that not all cryptocurrencies are the same. Bitcoin is the oldest and most widely recognized, with the largest network and the highest level of security. But thousands of other cryptocurrencies have been created since. Some of them offer genuine technological innovations, while others were launched purely as speculative assets. This diversity makes the crypto space incredibly complex. Some coins may represent real innovation, while others may indeed resemble financial schemes. One factor that has changed the conversation is the growing interest from major financial institutions. Big investment funds now include Bitcoin in their portfolios. Large companies are experimenting with blockchain technology, and even some governments are researching digital currencies. This institutional involvement suggests that at least part of the crypto ecosystem is being taken seriously. However, their participation doesn't guarantee success or eliminate the market's volatility and uncertainty. So, whether you believe crypto is revolutionary or just a risky gamble, there are some realities you can't ignore. The markets remain highly volatile, with prices changing dramatically in very short periods. Regulation is still a work in progress in many countries. And there are significant security risks. Exchanges have been hacked. People have lost their funds by losing their private keys, and scams targeting new investors are still common. For anyone thinking about entering the crypto space, understanding these risks is absolutely essential. So after all that, is crypto a Ponzi scheme? The honest answer is more complicated than a simple yes or no. The technology itself doesn't perfectly fit the definition. There's no central operator secretly redistributing funds from new investors to old ones. Transactions are transparent on the public blockchain, and the system operates through decentralized networks. However, parts of the crypto ecosystem can behave in ways that look a lot like speculative bubbles. Some projects are poorly designed, some are outright scams, and hype can drive prices to unsustainable levels. So the truth probably lies somewhere in the middle. Cryptocurrency is a technological innovation with both incredible potential and significant risk. Some projects may create lasting change while others will disappear over time. Just like the early days of the internet produced both revolutionary companies and countless failed startups. Cryptocurrency has sparked one of the most intense debates in modern finance. To some, it's the future of money, a decentralized system free from traditional control. To others, it's just a speculative market driven by hype and the fear of missing out. The reality is still unfolding. Crypto may reshape parts of our global financial system, or it might evolve into something completely different from what its early supporters imagined. But one thing is certain, understanding how it works is essential before making any decisions. In a world where technology and financial markets are constantly changing, knowledge is the most valuable asset you can have. If you found this video helpful, make sure to like and subscribe for more insights into finance, technology, and the systems shaping our future. And I'd love to hear your thoughts. Do you believe cryptocurrency is a revolutionary technology, or do you think it's closer to a Ponzi scheme? Let me know in the comments below. Thanks for watching.